Hello, Warriors. AJ, how are you? How's it going? Andrew Pert, nice to meet you. Welcome. Ingmar, Alexander. Who else is around?
Around or around?
Around.
I'm definitely more around.
I'm trying to get less round.
I'm so round it's not even funny.
All right. Well, I'm getting round too. So I guess that's part of
being in the team, right?
The good life of having money to buy food. and drink. Those are the calories, right? Blake,
Yep.
those are yeah.
Why are you looking at me? Why do you have to look at me?
I can't even see you, so I think you have a guilty conscience. Anyway, can we get a pop out of this euro?
I'm hoping for one.
Nice
divergent relative strength you have there.
Yeah, that's, I'm trying it. I'm trying EG. It did not make a new low when euro did, so it's actually
in any case
strong. Yeah,
the dollar rebound is still ongoing, right?
Yeah,
and we have to stick with it until it's over. And I mean, there is the potential for further upside in the days ahead.
Yeah, you know what I'm looking for in the dollar, Steve? You'll salivate at the levels that
Go ahead.
I know you're gonna think I'm crazy that it can get
no
there,
why
but,
why tell me first, and I'll tell you.
111.
I think it's very hard.
111.
I think it's very hard. I think it's very, very hard.
All right. I know a lot of people are looking for it to terminate up here, where it'll be a flat.
Yeah,
back.
I think that's towards 106 is going to be a very nice area to start looking for shorts. Of course, as always, right? It's one thing setting some levels ahead, and it's another thing reassessing based on how the price action develops on the way there.
Yeah. Well, I would like to see one more rally in euro back to 109. And this is actually my target down here at 61.8, just a shade over par. So any rallies, I'm thinking this is the first
If you're right about the euro, obviously you can be right about the DXY as well. Right, but in both cases, I think nothing is impossible. But with the current information that we have and the current technical picture that we have, I consider it a very unlikely scenario.
Okay.
Personally, I mean, this is a market, right?
Yeah. Yen, it sure wants a 140 handle. Maybe we get 41 or something, but I think there could be a pullback after that. What are yields doing today?
Yields remain very decently bid.
Yeah. So
not much happening today, but in general, they've had a good move higher during the past couple of weeks. They've definitely had a good run.
Okay, and crude, I want to see these two lows attacked. Maybe even take it out with a throw over, but I'm going to be looking at energy next time should we get there. I'm talking like it's a done deal. So, that's something I had my eye on. I still don't think the metal's at bottom. I still think 1920 is viable and 22. But these could pop, if the dollar gives up something. I mean, this is where I want to be a buyer of the dollar for a continuation move, right around 2.5 or so, about 100 pips lower is where I'd buy the dollar and be wrong over 102. This is a decent wave, we're talking about what, 3.5. I know people don't think we're going to stop till 104.50 and then get the correction. S&P is pretty wild yesterday. They don't look terrible.
No, they don't.
Despite,
As we as we were saying yesterday, it's one thing getting rejected.
Yeah.
It's a different story changing the trend, right?
Yeah. Yeah. Under yesterday's lows, I think there's problems, but it kind of held where it had to. We'll see. I mean,
in general, stocks remain very resilient, especially if you consider
NASDAQ.
Hey guys, I want to jump in here real quick.
There's
Ryan, are you
NASDAQ
around?
about to make new highs.
Yeah.
Hey, the BOJ is making some comments. What do you make of it? Take a look at the dollar yen right now. And Ryan, what are your thoughts here?
Yeah, he's for those who are not watching it, Urida said we could tweak yield curve control if balance between benefit and cost of policy shifts. He's added another comment about keeping 5 years stable and targeting the 10-year. But the BOJ must avoid tightening monetary policy prematurely. He's throwing out some options about what they can do if they start to end easing.
And when you see a 30 pip move in a market that's doing nothing, we have to stop and take a look. Yeah. So throw it on a 15-minute chart. Dale, you can see we're seeing a bit of a brisk move in yen right now. Not sure it's going to continue, but Ryan, sorry, I didn't mean to interrupt. It's just when things finally start happening, it's been like molasses around here. Go ahead, continue.
Yeah, bit of a delayed reaction, really. Yeah, a bit of a delayed reaction, but he's mixing it up. So he's given us some options on what they might do to exit easy, but he's also keeping the caution there by saying they mustn't tighten too prematurely. But again, this is the turning the oil tanker with a teaspoon. It's all happening. I don't expect this to collapse dollar yen, but if we get over this poxy debt ceiling stuff and back to normal things,
they all went home. They all went home for.
Yeah, I know.
Well, we're gonna talk about that timeline here in a moment.
And that Bank of Japan trade's going to come right back roaring in.
This is NVIDIA. NVIDIA, there have been a few earnings reports over the last month or so that have saved the market when it was on the precipice. You had Microsoft, you had Apple, and NVIDIA was blowout earnings. That's what happened here. I think.
Does anybody know what NVIDIA does?
Yeah, they make chips.
Yeah. I'm just kidding. I'm joking.
No, but
I would say the average person has no idea.
they're the only ones that really have the chips needed for AI. So that's the premium compared to the other semiconductors.
It's
is that true?
Yeah, but
they're the major manufacturer of those.
Yeah, but it's not only that. NVIDIA has been the number one. Yeah, the number one graphics card manufacturer for literally as much as I can remember going back in time. So they have like they have the majority of sales there. They have huge profit margins in their graphics card that got insanely boosted by the fact that then we got cryptocurrencies emerging.
Oh yeah, that's
and
right.
Cryptocurrency mining happens using graphic cards and not CPUs because it's a lot more efficient. And then NVIDIA also had a very big advantage on that. They even create graphics card specifically made to mine cryptocurrencies. Just to give you an idea, they don't even have display ports. I mean, they don't even have ports to connect a monitor on them.
I'm so sorry I brought up what NVIDIA does.
So in general, they are
a graphics card rabbit hole. Let's talk about the debt ceiling.
Very behemoth of a company.
It's a good company, right, Steve?
It is a good company, yes.
You like it as much as Apple? You think
now,
you really
are we talking about price or are we talking
as far as it being a good company?
It is a very good company, yes.
Okay.
Undeniably.
All right. From the bear. Bear can recognize quality in a stock. All right, go ahead, Blake. Let's talk about the debt ceiling. So no one's around to talk.
Yeah, let's just discuss it. I mean, we're one week away from the the so-called X date, which I was having this conversation.
People are questioning that now, aren't they?
Well, yeah, I mean, because you don't really know what the number is, but and that's the thing. I was having this conversation with Chris Weston last night on the trade-off, which I think it's worth talking about because it is exactly 1 day from, or 1 week from today is going to be the X date. That's June 1st, right? Now, June 1st is just some arbitrary, date that Janet Yellen threw out there, more, I think, to give people an idea of when we really need to start worrying about it. But here's the thing. We have the House just went on break today. Yeah. Like their Memorial Day weekend break. That's like literally going to take them, all the way to the end of the till Monday or Tuesday of next week. That gives us 2 days. And I was saying that McCarthy, he had promised that he'd give his Republicans, his House Republicans, 72 hours to review whatever they put in writing. And then yesterday he said, we plan to have an agreement in
principle.
Thank you. Over the week. Sorry, Dale. I'm glad your mind is much sharper than mine. My son graduated last night from high school. We didn't even get home until like 10:30 last night. And I get up at 3. So it's anyway. I'm a little scatterbrained. Needless to say, he's gonna be. He's like, he said, I'm gonna, we can call people back if we need to, but we might have to have an emergency vote.
Getz said, why should we make a deal when we have them as hostage?
Well, I mean, that's
Getz.
Well, yeah. That's the thing, and now we're only talking about the House, but then it still has to pass the Senate where, I don't know how close, the Senate's going to be like, yeah, thanks, but no thanks, and not being able to get it over the line. Because there are a few, Republicans and Democrats that are really, they want to see certain things done in the Senate. So my 2 cents is we're going to make it right to next week's X date, so-called X date, and then it's going to get real nitpicky. But the problem is we're going to start to see a lot of volatility come through the markets, and next thing you know, we're going to start seeing headlines and that really move. And I don't know if you really want to be long the dollar right here right now, like going into the final stretch of this until there's an announcement. And
depends on your time frame, Blake.
Again, well, here's the thing, Steve. If you start getting pushback on dates, not being able to make certain dates, and you already got 2 ratings agencies that are warning and putting the US on credit watch negative, or whatever you want to call it. The risks I see are that the dollar is going to be the currency that gets hit initially until there's a deal. And until there's a deal, when there's a deal, I think the dollar will rally quite sharply, actually. But until then, you're going to get some people that get nervous, and you're going to get some cold feet. And so when you take in comments like what just happened with the BOJ's UEDA, maybe the best place to be right now is short dollar yen while it's below 140 or 142. So just
what's been happening to the dollar?
Go ahead, Brent.
Sorry, mate. What's been happening to the dollar all through this? It's been strengthening all through this. So what's to suggest that it strengthens more if there's a deal?
Well, it definitely could. I think here's the thing that I'm looking at is, the technical levels that the dollar has been holding, or that has rallied to, is definitely on my radar right now. And what the hell is stocks are rallying at this moment? Sorry, I just looked up and just to see equities right now. The dollar definitely could continue higher. I mean, I'm not going to dismiss that.
Well, why is it going higher now as the risk of default increases?
Yeah.
Well, no, I think it's going to start really.
Guys, do you remember
really
what happened when what was it? Summer of 2012 was it? When
11.
was it? 11. You're right. Do you remember what happened when the US got downgraded and we had all that with the dollar? I mean,
no, not with the dollar.
Yeah, the dollar was was getting bid. Yeah.
Okay.
Yeah. Yeah, because it's, there are two different things here. Does anybody believe that the US has any likelihood to actually default? Meaning saying, listen, guys, you own US treasuries, we're sorry, you're not going to get paid back, or restructured. For example, hey, you guys that own US treasuries, we want to stay, we want to sit on a table with you and discuss some kind of a haircut. There's no way in a million. So all this is political theater at the end of the day. And that's why, as much as it sounds counterintuitive, I would not be surprised at all if the dollar actually moves higher as the risks are increasing for such a scenario, which sounds completely counterintuitive, right? I know that it sounds crazy.
What do you think?
My personal belief is that what is going to open the door for the dollar to start depreciating again is the resolution of the whole issue. So I disagree with Blake. Of course, it's a market. I mean,
and that's the funny thing is you're going to see a lot of volatility because there's going to be so many opinions flying around.
Yeah. No disagreement there.
So what if Biden, uses the 14th Amendment, and I think that's just eliminates the debt ceiling. Anyone familiar with that option that his allies are saying he should have as a backup plan?
Well, I'm not. Sorry, I was just going to say that would save us a lot of trouble, right?
That's what I want to say. I really hope they do so, not because I think that there shouldn't be a debt ceiling, but because even the way they have the debt ceiling makes no sense, because it's not an actual ceiling, right? I mean, I would be all for having some ceiling, although
even elevators, when they're going up, have a ceiling.
My first option, and I think that's the only thing that can fix the actual problem, is having a real agreement that we have to change the trajectory of the deficits. Unless there is finally at some point a political agreement that the country should be moving in a different direction, having it to do with its fiscal responsibility, everything else is charade, because at the end of the day, we know what will happen. What has happened the past 78 times, one way or another, in a more difficult way or an easier way, there's going to be some kind of concession, some kind of a resolution. We're going to lift very temporarily or for a little bit longer period of time the debt ceiling again, and we're going to find ourselves in the same position soon after, be it 6 months, 1 year, 2 years, but we're going to be having this discussion again.
Hey, Dale, I'm gonna take the charts. I'm gonna show you guys a couple of key levels, if you guys don't mind, really quick. And by the way, and thank you, Steve, for your opinions there. Just if you guys want to get a feed of the all the headlines that are coming out, and you want to read through them, like some of the BOJ commentary here, just go on ForexAnalytix right here on the Live Squawk feed. You'll be able to get through all that. I want to show you guys a couple of key levels that I think are important. So first of all, the euro dollar. Let's talk about the euro, where we're currently at, because if you take the this is a longer term range, which I think we're in. Right here, you can see it like this. The 200-day moving average comes down around 105. I wouldn't be surprised if the euro sees that, sometime this year, sometime in 2023, like over the course of the next few months. But where we're at right now is the 618 retracement of that range, right? So if you notice, oops, let me go back the other direction, actually. If you notice, we're right at the 618 retracement. Notice how we hit a new low and very divergent relative strength. We also completed a double, triple top, range completion. You can see it, that completed here to here, right? We had the bear flag pattern complete, 618 complete, divergent relative strength. I'd be a little nervous and a little careful being short here, just at current levels, just because of the multiple confluences of completion areas. Then you take a look at the Aussie dollar. The Aussie dollar is at, or slightly below the long-term 618 retracement. Completed the head and shoulder pattern finally. Never completed that head and shoulder pattern until yesterday. Even though we went down to range these lows near the 618, we never completed it until yesterday. That was a head and shoulder pattern from way back in February of this year. All right. Talked a lot about it on the week ahead videos for a long time. Even though we hit these lows, I was like, man, if we get down here, you know, there's going to be a lot of people that don't look far enough left, and they don't do enough of the homework to know that we are at a 618 despite bringing new lows. Then you look at the Kiwi. After the RBNZ this week, we hit brand new fresh lows. But again, if you don't look far enough left, you're going to miss the spikes that we hit over here in November of 2022. And you can notice that the Kiwi actually found support there. Wouldn't this be interesting if we start creating these false breakdowns, not only in the Aussie, but in the Kiwi? The Euro pivots off of 618, makes a little false breakdown here. Dollar yen at 140, 50% retracement. Now, 50% retracement in the dollar yen, you have to go look at the entire move from the highs in October all the way down to the lows. That's a 50% retracement. Again, not a lot of technicians are going to go out and do all of the homework. They're all looking at, 1 hour, 4 hour intraday charts. They're not really paying attention to the longer term stuff. We just hit the 50% retracement. So you're seeing these really key rejections from a lot of different pairs here. That's why I start bringing up the talk about like what happens now. We're getting to a very pivotal time, just a week ahead of the X date, where people are going to get a little nervous, whether ultimately the dollar goes higher or lower, because ultimately I think the dollar is going higher. But over the course of the next week to 2 weeks, can there be some jitters? Yeah. Can there be some volatility? Absolutely. Can you see both sides of the market? Sure. So I think it's going to be a really, really, interesting time. And I think this is where you actually have to, it's like you're in a plane and turbulence is coming, and I'm the pilot, and I'm going to tell you, take your seats, buckle up, because you're gonna have to be buckled up for this next week coming. It might have been the calm before the storm, but there's some volatility coming. So with that being said, we got a few minutes before Dale has his interview, and we do have weekly unemployment claims. We also have preliminary GDP numbers coming out today. So a lot of data coming out in just about 12 minutes. Stelios, I barely heard your voice. What are your thoughts about, should you be buying silver here? Because I made the case for it. I made the case for you last night on the trade-off on the Pepperstone's trade-off. Silver, when it got to 22.90, is about as low as it could go. What I said last night. Today we went as low as 22.91 before bouncing. What are your thoughts here in the markets?
Listen. Sorry. Listen. Okay. This is a good question. I mean, these lows, you call them very well. I still think that it's a 50-50 whether we get to 22 or not. And this will depend on how much stronger the dollar goes. I've said that I think the Dixie goes towards 105, most likely. So if that happens, that means that gold will have broken below 1945, 1950, which is support. And that's very important. If gold breaks below that support, you can bet silver underperforms on the downside. So I would still say it's 50-50. We go probably a little bit higher than 50-50. We go to 22. So if you are waiting to get long, I would suggest waiting some more. As you guys know, guys and girls, I'm long a full position now, slightly out of the money, and watching price action. But it will depend on the debt ceiling and on the dollar and how much it rallies before it starts moving lower, which I think it will move lower eventually, quite substantially.
All right. Well, thank you for your take.
Did you listen? Is that okay? Did you listen?
I'm listening. Now, Ryan, what are your thoughts going into today? What are you looking at? What should we be paying attention to? And are you buying yen right now?
No, I've just earlier on today I got knocked out my shorts, my long short try that was on the back of the BOJ, got knocked out at 139.50. You talk about a big level. Keep looking left past your fibs. You'll see 139 was one of the big levels on the way up in the big rally. Just before we took that, not quite as far as that. Come back a bit, come back a bit, come back a bit. So there, just before we took that second leg up, we went 139 down to 131, 128, somewhere like that. And then we took the big leg up. So that 139.50 is a big level, and we can't seem to hold above it. So that's going to be key for a run to 140. Euro dollar 107 is the level for me. That's the big level. Aussie dollar 65.20. Had a little bit of a zone. A few people in the room had support around 45, the 50 fib down there, or the 61.8 fib there. I've got a bit more down to 20. It's holding there for now, but the bounces are very weak. We're not getting above that 40, 45 area again. So it's a bit of a coin toss, this one. And the only other one is dollar China, still got the green light for further gains, making new highs, not dipping too much. And,
I was looking at the US dollar CNH. I would say
73.
ABCD completion might be coming in view here at the 618. So just, something to pay attention to. I know you're trading it. That's why I bring it up.
Yeah,
guys, can I add one more comment on silver? Okay, no, I'll leave it.
I'm not.
Our friend Charles.
Are you still? You really want to go back to silver?
Yeah,
really?
just very quickly.
You got to backtrack. You still live in the 90s, Stelios. I mean,
come on, you're wasting time. Our friend Charles says silver is sensitive to rates. Yes, why? Because silver and gold, they don't give you a yield. They don't give you anything, right? So when rates go up, people say, "Oh, I'd rather have buy bonds that give me something or higher yield." But the markets and all the algos and the correlation stuff, it's gone out of hand over the past years. Look what happened. 10-year US goes from 330 to 370 and silver goes down 15%. Does that make sense? In terms of, you can get more yield on a 10-year on the 10-year note? Of course not. If rates go to 6%, then there's a reason. But these moves, they are like really, strange. Anyway, that was it. Data flash.
Thank you. By the way, we're going to go there in a second. Look at the 10-year. We just hit the 618 retracement. I posted this in the ForexAnalytix chat room just earlier this morning.
Drive.
Is it? So let's just really quick. I want to show you the big reversal we've just seen there over the last hour and a half. Look at that reversal, Steve. Less than a minute. What are you looking at today? Anything that's? Shoot, he left. Yeah, okay,
he made me the host.
Oh, okay, all right. So
if you're in the house, raise your hand. I can't find you.
Ryan, sorry, you have one more minute. Anything else that you're looking at?
No, just the data. I'd ignore GDP unless it's a real big variation. It's the second estimate of 20. Look at the jobless claims in case we get a big number there.
All right, sounds good. And jobless claims, remember, like 2 weeks ago, we got a little bit of a jump, which is a bit of a worry. I think for me, I'm reminiscent of some of those days where we get big spikes and we get some movements there. So, we start seeing above like 270, 275. I think we need to start being a little bit more worried about the labor market, and I think the Fed will be too. So we got the 10-year yield that is dropping off from that 618. You can see it dropping off pretty aggressively here. We have the S&P, and then we have the dollar index right over here to the far left. Oh, shoot, I didn't mean to do that. And here is your data flash, and we have 5 seconds. So heads up, that comes with the ForexAnalytix platform, by the way. And here we go. What do we got? You guys seeing anything?
1.3. Okay.
Better, 1.3.
Okay. Not a lot of dollars.
PC prices in line. Jobless claims lower than expected.
Oh, wow. Look at the jobless claims numbers. Wow. That's a good number.
Core PC prices higher than expected. Okay, so good numbers overall.
Wow. All right. Well, the dollar is firming up a little bit. We've got the euro back at 107.25 almost. And the dollar yen just popped back up to 40s. So we'll see if the dollar, that's actually some pretty good numbers there. Especially the jobless claims. That's one that really is a bigger deal to me. Dale, is your guest here?
He might be out looking for him.
Oh, actually,
no, he's here. I can see him. He's here.
Yep.
He's here.
Dale, are you here? Okay.
Yes, I just went to turn on my light.
All right. Very good. Well, hey, I want to say, everyone, thank you so much for joining us today. Remember, we will be here tomorrow, but I need to mention this. It is Memorial Day weekend on Monday for us here in the US, but it's also European holiday for a lot of different countries on Monday. So we will not be broadcasting any of our shows on Monday, but we will be here tomorrow on our normal time. So we'll see you tomorrow. Dale, have a great interview. Thanks everybody for hanging out with us today. And I'll talk to you all tomorrow.
Lakshman, welcome back to F.A.C.E.
Good morning. How are you?
Good, Lakshman. How about you?
I
want to thank you for promoting your appearance. And you know what? Yeah, I don't know if you read what I said on LinkedIn, is that every time we talk to you, you leave us with clarity.
Wow. Thank you. That's a very kind, those are kind words. You're making me think. I was thinking of a comment from my teacher, Jeffrey Moore, and one of the, he's into cycles, which is different than some of the model building stuff. And one of the things he was very interested in was making decisions based on what you think you know. All right, that's the name of the game. And
at the time.
At the name of the game. And I forget which president it was, or it might have been one of the CEOs who said, I just need a one-armed economist, instead of on the one hand, on the other hand, it is complicated for sure, but you have to boil it down and make a call. And the leading indicators that we're using, they try to do that. They pretty much, they're summing it up as objectively as we can, and there's a strong effort to make it objective, and then it's up or down.
Okay, I want to talk about what you said in the promo about that Main Street is struggling, while Wall Street is shrugging. Now, I keep hearing about the consumer is not dead. We're going to have record travel here again over Memorial Day, air traffic, people on the road. Hotels are expensive and people are still going. Tell me what you see as far as the state of the consumer. They've been accumulating more and more debt. Is the consumer still healthy and still has funds to run on, or just are they living off credit cards to do the things because after COVID, people have adopted why save for the future? You better live now.
Right. Well, I think it's a little bit of everything you're saying, right? And so those are the cross currents that make it confusing in a way. You can select what you want and say, whoa, look at that debt, it's going way up, that means we're done. Or look at one of the personal consumption numbers and it's still pretty positive, or the restaurant is full, so there can't be a recession. And some perspective is helpful. I'm going to pull up a chart here, and forgive me, I'm not the best on sharing, but I'm going to try here.
You got it.
Let me see if I get to a chart. So I'm sharing there now. I think.
It shows it's a video.
That's a video. Now I'm getting to, here it is. Okay. And I think there we go.
Okay.
So our bottom line is that the recession, the consumer, what's going on with the consumer, all these cross currents back and forth, they're completely consistent with a recession, even though there are some numbers that are positive. And one thing I'd love to zoom in on here for you. So here, forget about the overall economy, forget about inflation. We're just talking, I'm just addressing this question: how's the consumer doing? Okay. And I'm showing you a chart from the late 60s through now. And the shaded areas you'll be familiar with are recessions.
Right.
And on the bottom, we have two different measures of consumption. You have real retail sales, which is the dark blue line. And then you have the teal line, which is real personal consumption expenditures. And what you see is that overall consumer spending growth doesn't always, that's the teal line, is the really broad consumer spending growth.
Right.
That does not always fall during recessions, number one. And number two, it's very often positive as a recession is getting underway. Those are just empirical facts. It's not my view about anything. This is well-revised hard data on how the consumer acts going into recession. So you can see, for example, at the start of these shaded areas, which we know in retrospect were contractions in the economy, you can see real PCE is positive. You can see my little hand there that I have, right?
Barely, but yes.
Yeah, I know. Let's call it a couple percent, okay?
All right.
I'm not going to 2-3%, whatever it is.
Yeah.
And that's not very different from where it is now.
Right.
Okay, so that's the number one thing to understand. And you can see we have recessions like the 2001 recession. It stays positive the whole way through. Okay, in that recession, I think you lost 3 million jobs.
Yeah,
right?
the dot-com bust.
Yeah. So here,
and they moved right to another asset class after that. You know, that was the beginning of this housing boom.
Yeah.
You know, after they popped the 2000 bubble, I remember, you know, living on the coast and people go, okay, well, you know, I'm out of the market. I'm just going to start accumulating more real estate. And they were right.
Yeah. And you start all the flipping. Yeah. All the flipping shows. So one thing, I take your point. Hey, some people are saying the consumer's okay. Jobless claims just now came in. They were better than expected. You know, what's to worry? Why me worry? Kind of thing. Remember the guy from Mad Magazine?
Yeah.
You know, so here we are, and just the reality is that teal line does not tank when a recession's getting underway, and even in the depths of the recession, it doesn't go. The real PC doesn't go that much. Now let's look at the more narrower real retail sales, the stuff you're buying at the store kind of stuff. And there you see a little bit more amplitude in the downturn. here, this chart is a month or more old. I think we have another retail sales number. It's gone down again. Real retail sales. I think you have 6 months negative growth. We empirically now, we've never seen 6 months of negative real retail sales growth outside of a recession. Okay, so that's just kind of where are we now? I haven't done any forecasting, right? That's just where are we now,
right?
In terms of these consumption numbers and what we know in the rear view mirror has happened around recessions. So that's the lay of the land. And then we're switching over. You go to the top part of the chart. That's a forward-looking indicator, the US LIX, the US leading indicator of consumer spending growth, and it tanked. Right? Look, it's a much more volatile series. This is meant to turn ahead of turns in actual consumption growth.
Yeah, it exploded during the pandemic.
Yeah,
everyone was home consuming, right?
You have a little shutdown in the recession where this kind of jerking down, and then boom, you got money in the bank, everybody bought goods, then you had the reopening, it kind of jerks up a little more, and then the sugar high starts to burn off, and we're coming back down, and here we're jerking around at what you could see again, just in retrospect, you could see these kind of readings have been associated with recession. The one exception is right here in the early 2011, 12. And at this period, we had
that was the last debt ceiling debacle.
Yeah, we're gonna nice segue. We had a bunch of stuff going on there. We had a slowdown. There had been, it was then Vice President Biden and Yellen were talking about the recovery summer. And we ran smack into a very hard slowdown. It looked to our eye like it could even be recessionary. It turned out to be the worst non-recession the hardest soft landing in the last half a century. We had 2 quarters where GDP just barely skirted positive. And that was the beginning of all this QE stuff. Okay. So today is a very, very different situation, right? Where, it's going to take some events, let's say, for there to be room for a policy reaction like that. I mean, I'm just trying to think, like, what's the lay of the land where you could get some attempt at that kind of stimulus?
How about the banking crisis worsening? I mean, I look at the bonds and the treasuries are under pressure. They almost look like they could make a move towards new highs in yields.
Yeah, and I 100% take your point. We had said, kind of looking at these cyclical tea leaves, so to speak. I think it's back in January of 2022. It's a long time ago. That look, they're going to hike until you get hit with a recession, which means you've got to have job losses, which we don't have, right? The numbers just now are saying, hey, not yet, right? Yeah. So you've got to get hit with the actual recession in your face, which is, I think right now we just need to see negative jobs growth, which we don't have, or something has to break. And so now we go back to the banks and the higher for longer and all this, and it's putting stress on all of them. We know that. It seems that they're saying, hey, we can fix all of these things that break. Let's just call them mid-level banks. With some, twine and Band-Aids and tape. But we're not going to shift off of our higher for longer yet.
Okay.
That's
so
what it seems
could be
on the face.
It sounds like contained that Bernanke said in 08.
Yeah, and I think you have echoes. You have echoes of that coming out now by whoever the policymaker is saying.
Maybe it's the Fed's goal, Lakshman, to they knew how the banks were positioned.
Yeah,
that everyone bought bonds and debt when rates were at Civil War levels. They hadn't been there in 160 years, and that they would take hits during their interest rate cycle. And like you said, they were going to keep doing it until something broke, and something did break. And then they still raised rates last time.
Yeah. So what
after something breaking.
So we don't have the system seizing, right? It feels like, are you too big to fail or not? And the judgment was, nah, you're not. We're gonna make a deal and have someone take you over, or the insurance company, the FDIC will take care of it. You're not too big to fail. You know, there were in 08, you had Lehman. Then you get the whole too big to fail kind of mentality, and we're just not there yet. Okay, so it's hard to predict what's going to happen with policy kind of stuff, but it feels like in order to have, well, you see, the other thing is inflation, right? You don't have the same inflation backdrop. It's radically different inflation backdrop. You know, it's all water under the bridge, and we've talked about it before about how they messed up on this inflation cycle, and they're trying to put that genie back in the bottle and regain the cred of inflation fighting, and they don't have that quite yet, because going back to the promo for this piece, Wall Street is quite excited by the pace of inflation coming down.
Yeah.
Hey, we're good to go. Yeah. Job done. Okay. You know, I cry uncle, stop. But Main Street is sitting there saying, wait, the prices are higher. You know, you talk about growth rates all you want, but if I try to buy a used car, it's almost 50% more than it was a couple of years ago.
Even beer,
freaking car, and even beer, all that stuff, beer and chips,
and now pasta. The Italians,
oh my God.
The Italians are going through a crisis.
Well, actually,
a pasta
I think
crisis.
Out of all those, the beer may be the most critical. But okay, all right. So
I paid $18 for a 12-pack. It's unbelievable. $18 for a 12-pack.
It's not fair. It's not fair.
And you know, it's not because of the cost of barley or energy at the plant, at the brewery. I think there's actually kind of that, maybe this is what economists mean, that once inflation starts, people just raise prices because they can.
Wait, what happened with Bud Light? Bud Light's cheaper because they got caught up. They got caught up in their whole thing.
Oh yeah. You know, getting back to banks, there are some talking about, to prevent future bank runs, of limiting the amount of cash or money customers can withdraw from their account. Do you think they're going to get that draconian?
Gosh, I hope not. I don't think so. When you get into full on, I mean, where do you get capital controls when the authorities are starting to freak out, right? That's when you get it. So we had it around the war, World War II. China's got some going on now, for example.
Yeah, they do.
Those are not signs of things working well.
Right.
So I really would really hope that we don't go there. I mean, at the end of the day, you've got you know, what's the pool that we're swimming in? We're in a free market capitalist economy. It has cycles. I mean, what do we expect, right? You know, they're going to happen from time to time, no matter what. And the thing is you try to smooth them out a little bit with policy if you can. I think that's fine. That's a reasonable thing to try and do. But we all know what's happened in the recent years. Some of that is external with the pandemic and reacting, trying to do whatever we're doing, fine. But here we are, after you goose something that much and you're that far behind the curve on inflation, you've got to have some payback. And here we are. And so now that is still unfolding. It's not over.
Is the Fed going to raise again in June? The market doesn't think so. Are they done? Are they on pause right now? I'm not sure if the Fed is your bailiwick.
Yeah, well, it has to be, right? In the sense that they are a big player, right? If you're controlling parts of the cost of capital, you're a player. That's an important driver of the cycle. We can see where we think we know where the direction of growth and inflation, right? And that, whether they know it or not, is going to impact their reaction function. So in that sense, yeah, we have something to say about the Fed. Let me go back to a share because I want to switch gears to
and I also we have I think a very insightful question from one of our attendees.
Yep.
Colleen Banks. What new insights have you gained from the current cycle? Anything new?
Oh yeah, no. Probably so many, and I'm still trying to figure it out. One is I do get surprised, but it's been, I've been surprised for a decade, so I got to get over it at some point about how about how much they'll intervene.
Yeah.
I mean, it's gargantuan. And we all get brought up to do the right thing and this and that, and it just seems like this is really over the top kind of intervention, which speaks to, I think there was this whole thing, after the financial crisis and the Great Recession, which wasn't supposed to happen. You were quoting Bernanke from 2008, right?
Yeah.
These guys were shocked by all this. And something that is a feature, which is a recession of a free market oriented economy, is seen as a bug. Like, we got to get rid of it. And by hook or by crook, no matter what the cost, we're going to intervene and try to get rid of it. And we have a decade of that, which was enabled. So all the post-GFC period, that whole decade, we go to ZIRP and very low interest rates, which we were able to get away with for several reasons, including the fact that China was exporting a lot of disinflation.
Right.
That is not the case today, number one, right? Number two, we're way behind the curve on inflation, right? This thing was a big screw. I'm showing a chart here of inflation. So the bottom line is the target. That's the thing everybody's talking about. The black line is the headline inflation, and the gray line is the core inflation. This is a few months old, but it's the general picture, right? This is from March 3rd. Okay. Now, on the top line, you have the future inflation gauge. That's a very important indicator. And here is the policy mistake, where it's transitory, but the forward gauge runs to a 40-year high. Okay. And here we get a 40-something year high. I don't know exactly, but it's roughly. I'm not suggesting magnitude is the strength of this. I think it's direction. So here it starts to roll over, anticipating the peak. We have Ukraine in here. We get a little supply stuff that happens in here, is the Ukraine and all that interruption. But you see the basic cycle turn down. This is the interesting part. There. Look at that. That's going sideways, and I'll share with
going down, so inflation's sticky.
So I'm sharing with you, this is, giving you a treat here. That's continued to go sideways, okay, through the latest reading. And that is all of that sticky stuff. Now let's go back and look at the guts of what's going on. Food and energy can help drive the headline and whatever, but here we've got core. And yeah, you know, the whole rent stuff is a problem, and will, you know, hopefully be helping that down. But at this point, a key thing holding that gray line up and keeping it sideways is wage growth.
Okay.
And now go back to your beer. All right, I'm going to bring it all back. It all comes back to beer. Okay, and chips and used cars. Okay. So here you've got this idea, once you get inflation around you. Look, remember all the companies, all the businesses had no pricing power for a long time. And now they've got pricing power. And your nominal revenues look okay. I haven't seen the very latest data, but it was a month or so ago in Germany, by the way. Today, you get negative GDP. They're in recession, right? So probably started toward the end of last year. The Germany had, I think, headline retail sales, consumer kind of stuff, 2%. But when you adjust for inflation, it was -7%. So you have this illusion with the inflation. This inflation gives you this illusion that you're cruising along. But
it's only nominal gains.
Yeah. And so managers, it's not that managers are unaware of their input costs. They are. I'm not saying that they're dumb or don't get it. They get that. But it kind of feels okay. You got a handful of cash, right? You have the memory that it was hard to hire people last year. So you don't want to just cut them right away. You're hoping for that second half recovery to bail you out. And you're hoping that you can charge $18 for the beer. And so far, so good. But you are getting squeezes.
I'm not going to that liquor store again.
Well, I mean, the cure for high prices is high prices, right? So yeah. Those will go down, and you can stock up later. I don't know how long you can hold beer for it before it goes bad.
Can we talk about a little bit about the debt ceiling and how that
So just to put a pin in it, Dale, real quick on this chart,
go ahead.
Higher for longer, right?
Higher for longer.
Higher for longer.
That's what they're saying.
They're saying it. They even said something which I thought, just was a slip of the tongue, but he said it, and he said it more than once, which I want wages to go down.
Yeah.
And now, again, going back to growth rates and levels, he didn't say wage growth to go down. Because I'm talking about Powell. He talked about wages to go down. I got to tell you, for wages to go down, you need to see that unemployment rate moving, and not by 1/10 of a point. So Powell is saying certain things that are completely consistent with higher for longer and hard landing. And the question will be that
will he have the political will to follow through?
Yeah, I said that we used to call it the intestinal fortitude. Does he have it? Does he have it?
I call it intesticle fortitude.
All of the above. I mean, he's getting incoming fire already with the unemployment rate low. So now let's go to the debt ceiling. And I'm sorry, on the learning of what do we learn since the COVID crisis? I want to just throw in one more thing. We're still in the backdraft of that stuff, right? We lost a ton of older workers.
Yeah, they're not coming back.
And they're not coming back, and we're getting really, really crazy stuff as a result, right? Anecdotally, you'll have like a seasoned construction worker who says, that's it, I'm done. And if you try to replace him or her with someone younger, they're just not as productive.
Yeah.
It might take 2 of them or more to get the same work done. So our productivity growth is just slamming. It's just not good, which is inflationary.
Right.
Okay. So let's move on to the debt.
Okay. So let's talk about the debt ceiling. Kabuki theater, or is there intention? Some people are saying, let it happen. Matt Gaetz is saying, well, we have the Democrats as hostages right now. The X date now doesn't matter. We have more time than June 1st. Is this 2011 or worse?
This is a bit more of a political discussion. I think that it's right now it's like a hot potato, right? And whoever's holding it gonna get blamed with it, they'll cry uncle. And so that game is still going on.
Maybe they all want an excuse. The Republicans want to blame Biden because the Democrats, knowing that the economy, you're going to be right, they probably believe you're going to be right.
They want to blame it on the debt ceiling. 100%.
Well, no, how are they going to win re-election without a scapegoat or an excuse? And the Fed probably wouldn't mind this happening either, because it would give them cover. Well, it wasn't our policy. It was the government.
It's so funny. It's so interesting. So real time, I've done real time inflation monitoring since 1990. So I've seen a few. You know, there's obviously many more of them, but I've seen a few in real time. I have to tell you, people don't recognize recessions when they're starting. It's only you see it in retrospect, and it's typically around an event, a negative event, and you say, because of this really bad thing that happened, there was a recession. And so, for example, 9/11, horrible, right? Totally joined with that recession in everybody's mind. However, that happened 6 months after the recession started.
.com pop.
You know, and all of these things. So all of these, the stories that you think are like Lehman, right? It's linked with the recession, but it happened way inside of the recession. So let's say debt ceiling, there's some blow up and car crash in the coming months. It still may be that the recession actually started earlier.
Right.
And the debt ceiling will be associated with the recession. And just to clarify on that, because it sounds a little confusing, how could a recession have started without jobs being negative? That has happened several times. The most extreme was in the mid 70s, in the 73, 75 recession. Jobs grew for 8 months into the recession and then fell. And that was a money illusion kind of backdrop, an inflationary backdrop. So that has happened. I don't know literally that that's happening now. I think this whole COVID messing up the workforce is making it super hard. So I think that we have a very tight workforce because of COVID. We've got the money illusion.
We've got a tight housing market because of supply.
You've got tight.
He's trying to break
supply change.
Yeah. We have all of this going on. So when are we going to get the headlines of what you predicted 8 months ago?
Well, either something big breaks and everybody says, aha, there's a recession because of the debt ceiling or whatever. And then they'll say, oh yeah, that was obvious. Okay, fine. But that'll be the story. Or you're going to get some negative jobs numbers, and it'll probably take a couple of months of that before people say, okay, it's here. And, you know, I don't do like monthly job number predictions like that, but it's before year end. It could be by the fall.
Okay.
I mean, and you see managers for the most part, unless you can brand yourself an AI brain of some sort, saying that I'm letting people go.
Okay.
Right. I don't know. Can NVIDIA hire everybody? That's
I just wanted to put your website up.
Oh yeah. Thank you. Thank you so much for doing that.
So this is where you could go to get research. So your research, retail people or, big companies are your main, your main clients, but do retail people that just want to learn more about, what you're doing, go ahead and also subscribe?
Yeah, well, it ends up being a little pricey for retail. I mean, we have family offices and stuff, but But for retail, what I would say is go to businesscycle.com and check out the resource center. Is a pretty good spot. And one of the things we're going to do there is always put our any interviews. We'll throw this one up, for example. And the other thing that's here, that's a new thing that we've started to do, is this thing called the column. And this is not an interview. This is where we're trying to share some of the institutional memory nuggets of it with everybody.
Wow, that's great.
So this is just straight from us, and you can kind of get in there. So when you're playing around and you're wondering, like, what's the Fed going to do? This is a nice piece to take a look at.
Comparing the 70s.
Yeah, it kind of gives you some of that cyclical history and the backdrop of the money illusion, all that stuff. And then, of course, you could follow us. I mean, we try to do stuff on LinkedIn. Like whenever we're doing something, have something to say, we throw it on LinkedIn or Twitter.
Okay.
And that's how sophisticated we are with the social media.
That's my marketing plan too, Lakshman. So let's wrap it with how much longer will Wall Street be able to shrug this off?
Oh,
it seemed like they were starting to, it's really concentrated in about 8 stocks holding up the whole market.
Well, we have that. So you have that whole concentration in the tech AI kind of stuff. Every time, it seems to be that they're fixated on the Fed, for better or for worse. Maybe the debt ceiling. The debt ceiling, let's say it gets resolved, there'll be a little rally, but it didn't really change anything. Okay, nothing really changed in the cycle if that happens.
Yeah.
So it's like, is the Fed done? Is the Fed done? Is the Fed done? So I can.
How about earnings? They've all been beating. NVIDIA blew out earnings. Apple had good earnings. Microsoft had blowout earnings. So isn't there going to have to be some earnings compression?
Well, yeah. I mean, it would be great if those were the companies. If those companies were the U.S. economy, but they're not. Right.
Yeah.
The U.S. economy is that's a slice, which has a structural, technological kind of opportunity. But when you go to the full economy with all the real stuff and the construction and the people facing services and all of these things, it's a very different story. It is discretionary. At the end of the day, Apple can do what it's doing. And you have to say, is an Apple phone discretionary or non-discretionary?
Yeah.
Is advertising discretionary or non-discretionary? That starts to hurt. It starts to get in there.
I'm bearish Apple. I'm short Apple.
I mean, if they have another story, away from the phone, right?
Yeah.
If it's away from the phone and they're selling something else, by all means, go for it. But here, if push comes to shove, do I need to get the next phone?
No. I've had phones for 8 years. And you know what? China is a big deal. They just, banned Micron chips.
Yeah. China, by the way, China is the thing, right? So one thing on China to share, and then I got to wrap too. We're running long. One thing on China.
Can't help it.
Yes, there's so much to talk about. So one thing on China is, yes, the reopening, they technically pop out of recession. They've got some services activity. Okay. Their industrial side is not grabbing.
Yeah, look at copper.
Yeah.
Dr. Copper has COVID.
So you go back to Wall Street. Wall Street's like, okay, we're done, right? Powell is done. The China's back online. We're good to go. Oil should go up. Yeah, look where it is. Look where copper is, right? Because that industrial piece is still slipping. It hasn't grabbed yet.
Yeah. Okay.
And so there, again, so everybody's sitting there going, are we there yet? Are we there yet? And we're not there yet.
So it used to be when America gets a cold, the rest of the world gets pneumonia. Maybe now it'll shift to when China has a cold, the rest of the world gets pneumonia.
Well, they've been a big player with that huge debt growth last time, and people are wanting it to go back to that, and that's not happening.
Lakshman, See,
Thank
you
you.
did it again.
I hope
You
it's
did
clear.
it
I hope
again.
it's clear.
I was so confused, and now my confusion is clarity. And everyone, please follow Lakshman on Twitter at Business Cycle, or go to his website,
Yep.
economiccycleresearchinstitute.com, and keep up with this guy, because he hasn't changed his tune since you and I have been talking, and we'll have to have an expensive beer when the headlines hit
Homebrew.
the
Maybe
Wall
we'll do a
Street Journal.
homebrew.
All right,
All right.
Lakshman.
Thank you.
All right.
Bye-bye.
Thank you very much.
You're welcome.
All right, everyone. Hope you enjoyed. Follow Lakshman. It's a must. And you could join the team in 5 minutes on the Morning Edge. I'll see you guys tomorrow, and we're going to have Mark Chandler tomorrow to make up for the other day. Good hunting, everyone. Adios.